We're here in Monte Carlo for the Rendez-Vous de Septembre. For AM Best TV, I'm Richard Banks. And I'm joined now by Tim Gardner, who's CEO, Lockton Re. Tim, welcome.
Thank you.
We're back here in Monte Carlo, first time for a few years. People are picking up their relationships. What's the messaging from the ground?
Yeah, I think there's a lot of excitement. People haven't been together for a long time and in this venue. So there's certainly plenty of excitement of people getting back together. And frankly, we have a lot to talk about as an industry. There's a lot going on in the world in various pockets, and certain subsegments have seen some loss activity. So it's been a pretty healthy couple of days.
Let's drill down into some of those things that people are talking about. So hardening market, hard market. You're a broker. You have a slightly different view from the reinsurers. Tell us a little bit about that.
Yeah, I like that phrase, hardening. I don't think it's a hard market yet. I mean, you look at combined ratios, and they're still reasonable, right? I don't think we're at the stage where we're making huge reactive changes to marketplaces, but clearly there are some areas that need more rate, and I think that's a conversation that's applicable from insurance to reinsurance to retrocession. It's sort of across the cycle where it feels like certain products have been underfunded for some period of time, and so I think we'll see corrections in them. I think we'll probably have some supply demand mismatches in some segments, but generally this market feels up but orderly, I think is probably the way we would define it.
That's a lovely term. So a lot of talk about risk appetite and the balance of portfolios. How do you see that from a broker's perspective?
It's so varied these days. I mean, you think about there's probably two themes. If you just take cat as an example, which has obviously been a hot topic while we've been here, there are those that are using cat as that dear asset that are going to trade for other opportunities, be them casualty or specialty treaty opportunities. And then there are others that have made a business on focusing solely on cat and actually highly volatile lower end cat. So I think the market sort of found its equilibrium, frankly, where different capital sources, different risk appetites have all settled in, and we've been able to serve client needs because of it.
So when we talk about risk appetite, we talk about underwriting risk appetite, but we also talk about investor risk appetite. Do you get a sense of investors' attitude towards insurance risk at the moment?
Yeah, I think that's a tougher space. There was a point in time where the brokers really covered the investors. If you think back to years ago, when an underwriting company was being set up or new risk takers were being set up, particularly in the reinsurance side, there was a lot of broker connectivity to that. And I was reflecting on it as I was talking to reinsurers. Now, there isn't a cat reinsurer that doesn't have some access to third-party capital. So that group is across the globe routinely having conversations with investors. And I was talking to one of them. I asked the question of how many investors do they chat with through the course of the year, and they said in excess of 200, which was a far larger number than I had expected. But I think the overall sentiment is pretty negative, quite frankly. I think it's a couple of years of bad loss experience, and we know the issues that have surfaced with collateralized cat reinsurance, with trapped capital and some of the other phenomena. So I think we're going to need to have a year or two of some better returns, frankly, and some price movements before that tap opens up again.
So the last 3 years have changed people's attitude or challenged people's attitude to insurance a little bit. Is there more that the insurance industry and the reinsurance industry can do to rehabilitate, do you think?
Yeah, I mean, so much of it is about sentiment, and it just happens that the world, there's a feeling that the world is a riskier place, and I think that's probably a fair assessment. There's also a view that investors and public markets don't love volatility right now. So, the dampening of volatility we're seeing across all segments of the insurance business and the reinsurance business. And that means all sorts of things. That means changing portfolio construct. That means changing risk appetites. That means buying potentially more reinsurance. So, I mean, all that dynamic is playing out. And a lot of it is just a function of you've got to cater to that world that doesn't want volatile returns anymore. So, management has to adhere to that.
So that suggests that an operating environment which perhaps people haven't seen before, how does a broker like Lockton Re adapt to that?
Yeah, I don't know that I would say it's an environment we haven't seen, quite frankly. I think it is a cycle, and you're going to see various phases of that cycle through the course of a career. For all brokers, and we absolutely think of ourselves this way, we're really in the analytics business. We spend an awful lot of time helping clients assess gross portfolios, think about the volatility in those portfolios, and then trying to reflect that back to their own financial aspirations. So that could be net appetites, that could be profitability expectations, capital expectations. So really, for us, it's prioritizing what our clients are solving for, and then using the analytical horsepower to help them achieve their goals.
Tim, thank you very much indeed.
Yeah, my pleasure.
For AM Best TV, I'm Richard Banks.